This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Hi, everybody, and welcome back to The Wealth Puzzle. It is not Mike, it is Owen today, and we have a really fun thing to talk about. Before I give it away, or maybe I already have in the title of this video, I do want to begin with a little Texas recap. We have had a very busy summer doing lots of seminars and traveling around and work conferences and all the above. So we do apologize that we haven't put any great videos out as of the last, month and a half. But going forward, we're back on track. We're ready to dive into the thick and good stuff. So pay attention. We'll have some good videos dropping very, very soon. So as you probably saw from the title of this video, we are going to be talking about bonds. What? There's nothing fun about bonds, right? They're boring. They're lame. Well, that is the general consensus, but the goal of today's video is to talk about a specific scenario happening in the bond world, the Treasury buyback program that just happened with Scott Bessent's Treasury Department. So we'll talk about why it matters, what things it's really influencing, and why I think you guys would all benefit from really understanding the bond world a little bit more. All right, so let's throw this up here. And before we dive into the fun bond stuff, let's talk about the economic calendar. So really the next day or so, we're getting some good inflationary data as well as a good jobless claims report. So again, we'll get a good decent report of what's happening in the employment market as well as with inflation. But more importantly, on Friday, Federal Reserve Chair Kevin Warsh will be speaking at the Jackson Hole Economic Policy Symposium. It's a good word. Make sure you tune into it, right? I got to be careful here. Not boring. I should be excited for you guys all to tune into this. The reality is I don't think any of you guys will, but have no fear. I will. Mike will. Tana will. We will have some content based around what they all are. Talk about at this symposium. It's good stuff. The markets are pricing in some nervousness, as they always do when the Fed comes out and meets together. So we'll see what they say and how the markets move. I'm going to pull this off, bring you guys back to me. Before we talk directly about the buyback program, we need to maybe dive into some context here. I think there's a lot of confusion around what is happening when they cut rates. And when I say they, I mean the Federal Reserve. So when the Federal Reserve makes cuts, the actual rate that they're cutting is actually the rate at which banks lend to each other overnight. They do so for liquidity reasons, right? They have to keep a specific amount of reserves in the bank. And so it's this whole thing. That overnight lending rate inherently will move the shorter end of the curve, right? So the 2-year, the 5-year, those rates that we see, the Treasury yields, those will move. However, the 30-year Treasury yield, so the long end of the curve, that one doesn't move. And so oftentimes when we're talking with clients or talking to individuals, just in general, I think the consensus is that the Federal Reserve is cutting that rate, right? So when they cut rates in the next week or two, if they cut rates, people think that they're cutting the long end or the short end or so one of those Treasury yields, and they're not, right? They're cutting a mechanism that influences those rates. And so I want to focus a little bit more here on the 30-year. Like I said, the overnight lending rate, that will inherently push and move the needle on the shorter end, the 2-year and 5-year Treasury yield, but the 30-year, sort of a different monster. When you look at the equation of the 30-year, it's influenced by, call it 3 different components. You have expected short rates plus expected inflation plus the premium investors demand for the risk that they take, right? If they're wrong about inflation. And so if you get all three of those right, then you can sort of move the longer end of the yield curve. If one of those is out of balance or, I don't know, different from the other two, then the yield curve can kind of do some weird stuff, right? Might stay static, might move down, might move up. It's anyone's guess. Now, if Warsh decides to cut rates, it moves one element or one piece of that equation. The remainder of it is up to the market, right? It's up to the premium that investors are willing to pay, and it's up to the inflation expectation going forward. So does the market buy the bluff? Do they decide to call them? All of that sort of plays into the overall equation of the long end of the yield curve. Well, why does this matter? Well, if we look back at, let's do this, the longer, we look back at the, we look back at the last Fed meeting when Warsh held rates steady, the market shot up, but so did the long end of the yield curve. That 30-year, look, here we go. That 30-year shot way up and then fizzled out, kind of came back a little bit. And then when they did this buyback program, it shot up again. And so now we're sitting at 5.25 at the 30-year. This is, we haven't seen highs like this since 2007. And so this is a little bit problematic, especially when the government has to start refinancing some of this debt. And on top of that, keep the entire economic machine moving. So the Fed decides to keep rates steady, and then the rates increase. They actually shoot up a little longer because that just means, hey, we're likely going to see longer rates or higher rates longer. And so that inherently kind of pushes the overall market up. And so Scott Bessent is sitting in a weird place. They have to refinance some debt. They also want to keep the money machine going. We've got a lot of CapEx spending from AI. And so the whole thing needs some, call it stimulus. And I'm not necessarily talking about direct dollars, but I am talking about some relief from higher rates. So Scott Bessent comes out and says, hey, look, we're going to come out and we are going to buy back 10 to 20 year and 20 to 30 year bonds. And we're going to do so at the clip of around $2 billion. And then he later came back out and said, hey, I'm going to double down. We're actually going to do $4 billion. So the market's like, whoa, that's crazy, right? We're trying to cool inflation and you guys are going to buy back bonds. How do you buy back bonds with money you don't even have? And so that's where some of this confusion arises. You see, they're not necessarily just turning on the money printer. They're starting to reshuffle the cards. They're playing the same hand, but they're doing so slightly differently. So that's why we get to the Treasury buyback. So I made a really awesome, cool graphic that perfectly outlines what happens with the Treasury buyback. So typically, new issued bonds, they're constantly being traded. They call these on-the-run treasuries. But as those bonds age, they become off-the-run treasuries. Investors continue to hold them. Trading volume drops, liquidity dries up. And if a bank or a hedge fund or the government needs to unload billions of dollars of older bonds, finding a buyer becomes really, really tough to do, nearly impossible. So you do things like a Treasury buyback. The U.S. Treasury uses cash to buy back these illiquid older bonds from primary dealers, and they do so by funding it with these new short-term, highly liquid bonds. So in my diagram over here, you'll see our Treasury department. They say, hey, look, we're going to buy up these old bonds. We'll give you some cash, and we're going to give you cash by issuing these short-term new bonds, these highly liquid bonds. So if you think about that, right, it's just a game of supply and demand. You've got the long end of the curve where investors are saying, well, there's not a whole lot of, I don't want to say, there's just not a whole lot of a world where investors can sort of trade and get in and out of those long-term bonds. The supply is relatively low. It's dried up. The liquidity, the volume, all that stuff just isn't there anymore. And so people are holding on to those. And so all this is saying is, look, we're going to buy those from you. We'll be the buyer, the lender of last resort. And in return, we'll give you the short end stuff, and we'll give you a lot of it. It will give us a giant influx of liquidity and movement. And hopefully, right, all else equal, rates will come down and liquidity will grow. That's what's supposed to happen. It doesn't always happen that way. And so that's sort of what we saw occur when they, let's go back here, bought back those bonds. That's happened right around here. And then yields continued to rise. The market said, I don't believe it. I don't think that you can simply artificially lower rates by just buying back older bonds and increasing liquidity. The market is saying there's something else going on, right? Of our three components, inflationary fears are still there. And then the long-term growth outlook of the market is still there. And so inherently, the bond market is going to require a higher premium in order to lock up that money. Okay. That's sort of what the bond buyback program is supposed to do. It didn't really work, right? It took about 48 hours, and then all of the tick back down in those yields that we experienced, well, they were kind of, I don't know, bought back, if you will, within a day or so. And we're sitting sort of right at that 5.25 and hovering there. We're stuck there. So it'll be really interesting to sort of start to see where things go, especially as we hear what the Fed is going to do. This stuff just puts a whole lot of pressure on borrowing money, on infrastructure outside of just the federal government itself. I wanted to show this one as well. This is CapEx spending for AI, so money being borrowed and being used to fund the AI adventures. It's also at all-time highs. And so assuming all else equal, rates aren't going to come down anymore. It just means that things are going to stay expensive. The national debt, let's look at this one. That one has just crossed that $40 trillion mark. And so the interest payment itself is just getting absorbently larger and larger. I think the last thing I saw was it's now taking up more than we spend on defense spending and Medicare spending. So that's just the interest alone, right? Just to manage that debt. And so you sort of put yourself into a weird position. The Fed is now playing a game of chicken, and Scott Bessent is playing a game of what levers can I push in order to move the market. Scott Bessent has not given up. He is trying everything he can to refinance this national debt at a lower rate. Meanwhile, the Fed is saying, you know what? I don't think we can cut rates. And I actually do think they're on the right track here. If you just simply cut rates, well, now you're creating an inflationary environment. Lower rates, higher inflation. That's just sort of how it goes. And so again, they're going to play that game of chicken of, well, let's let the market dictate what happens. Meaning, all else equal, the market's healthy. It's still moving. There's still liquidity. It hasn't frozen yet. People are still spending money. Consumers are still fine. We don't necessarily need to cut rates. And then on top of that, we also don't necessarily need to hike rates, right? There was a fear, there was a worry, the increased probabilities of rate hikes was growing exponentially. Mike put out a video, I guess it was probably the last video we just put out, talking about how he doesn't see a world where the Fed actually does increase rates. They just can't. It would stall the market. It would create some liquidity concerns. And so it doesn't necessarily make sense to do so. So brings us right back to where we began. The Fed is in a stalemate, a game of chicken. Who's going to move first? What's going to move first? And I think they're doing so relatively responsibly, because if you sort of let the market do what it wants to do, then the idea is the market movers, the invisible hand will do so correctly. without artificially trying to sort of put a Band-Aid over the whole thing. The last thing I want to touch on, leave you guys with some good news. The market is trending in the up. We're actually above analyst expectations from where we thought we would be at this point in time. This is the last thing I'll talk about. This is the U.S. Treasury yield curve. This is a recession indicator. It is a recession indicator that typically is a bit lagging, but you can look at it in terms of, hey, where do we think we're going in the future? Kind of counterintuitive there, but nonetheless, when this yield curve is not inverted, but shaped like this, if you will, meaning the short end of the rate yield curve is lower than the longer end, you have a market that's relatively resilient. It means, again, people are spending money, and all things are pointing towards the good stuff. Now, if this yield curve inverts, so the shorter end is they're requiring higher yields than they are on the longer end. Well, now you've got yourself into a sticky situation, and that usually precedes that of a recessionary scenario. We have gotten ourselves into that over the last couple of months, couple of years. We've approached it, and we didn't necessarily go into a recession. So it's not always perfect. None of this stuff is perfect. None of this science is perfect. A lot of this is just, hey, this is what we can understand. This is where we are. This is what our best guess is. So you have to take it with a grain of salt. Did I even show it? No, I didn't. This is what I was trying to show you guys. I apologize. This is the yield curve. When you see the longer end higher than the shorter end, that's healthy. When the shorter end shoots up to way up here and the longer end is below it, well, then that's an inverted yield curve. Sorry, I didn't realize I didn't put it up there. So a lot to consider, but it's important that as investors, we understand how the bond markets can sort of manipulate the overall equities market, the overall economy together. It is very, very important. It's a huge player in the entire thing. All right, you guys, I hope that was helpful. That's all I have to talk about today. Hopefully you have something to share with your friends. Tell them about bonds if they'll let you talk about them. Remember, they aren't boring. They're awesome. They're exciting if you let them be. All right, we will see you guys next time.